All right, everybody. I have 12 o'clock on my end, so we're going to go ahead and get started. Got a lot of people still filing in, but if you've never been on one of these before, we do about a half hour, sometimes 40 minutes, and I'll throw a little Q&A in there if you want at the end. This is not a long thing. Really try to get to the point of doing this so you can get on with your day. So today I'm Jason Kojak. I'm the owner of Hemlock Realty. We work over at Compass. I also teach some at NC State and run some investing stuff on the side. And so kind of have a wide berth of a lot of different things. Real estate started in 2002, so I have a couple decades of experience under my belt. And really today I want to talk just about kind of residential lending and hopefully more just so the things that can kind of trip up brokers or buyers or sellers. I'm not going to go into hopefully really, really basic stuff that we all should kind of already know. So the first thing I want to talk about is just how our rates actually work. The sheer number of uh, brokers, buyers, sellers, media that don't understand how rates work, it's really, really mind-boggling. The number of times as a broker, I hear somebody say, well, the Fed is meeting next week. They just finished up their meeting yesterday, for instance, and they didn't raise rates or they didn't lower rates or they kept rates the same or they did or they didn't, whatever it may be. And they think that translates to mortgage rates. And so I just want to take a second or two and kind of break this down in a really simplified version. Look, when we're talking about mortgage rates, there are a ton of factors that come into it, not just your personal factors, income, credit score, all that good stuff, but just on a grander scheme of how these things actually work. So there's basically a couple of factors at play here. So the first is yes, when the Federal Reserve makes a policy change, they are changing a interest rate. And in essence, they're changing the Fed funds rate. And all that is, just so you understand, is that anytime you are a bank, so if I'm Bank of America, I'm Wells Fargo, I'm Fifth Third, or even a local bank, whatever it may be, the Fed requires I carry a certain amount of cash at the Fed at all time. Okay. And based on my deposits from clients or loans that I've given out, that cash fluctuates all the time. And so it's very, very, very common that for a day or two, I may fall underneath that minimum from the bank. And so what I do is I call another bank down the street and I say, hey, can I borrow $100 million for 24 hours? And the other bank says, sure. If that interest rate that the other bank charged me wasn't regulated somewhere, gosh, they would charge me whatever interest rate they want because they're competition, right? And so the Fed is just adjusting that rate, okay, the Fed funds rate. And so as that gets lowered, or now even consideration of getting higher, it costs that bank that needs the money more or less money to borrow that same exact amount. And the banks aren't in business to lose money. So that charge gets filtered down to their clients. So, how does it get filtered down? Well, it gets filtered down in what we call short term rates. Mortgage rates are long term rates. And so it gets filtered down in things like car loans, credit card loans, anything that can fluctuate really quickly that has an interest rate is how that gets impacted. Even home equity lines of credit. But mortgage rates, they're long term rates. So they don't get, oh, I think I may have lost. Let me switch. I'm going to switch over my here just to make sure we don't get um, pinpoint. So hopefully everybody can hear me now. I'm going to put these things away. Um, Let me just make sure I've still got you there. All right, so hopefully everybody can hear me now. Sorry if there was an issue there. But anyway, so the Federal Reserve changes those interest rates. They make it more expensive or less expensive, and it filters down. But those are short-term rates. Now, over the course of time, short-term rates will impact long-term rates, but it is not something that occurs instantaneously, okay? And so what occurs instantaneously? Well, that's where long-term rates come into play with the treasuries. And so the way to think about this is that anytime a bank puts together a mortgage, so I walk into Wells Fargo, for instance, and I get a loan. And with that loan, let me turn this back one here. And with that loan, they go ahead and they give me $500,000. Well, the bank can't continually make loans for $500,000 and not get reimbursed. Okay. And so let me just see here. I think I'm having it. Can everybody hear me okay? Can somebody just put in the chat box that they can hear me? There's like an error popping up, and I just want to make sure that at least somebody can hear me on here. Oh, perfect. Okay, great. Okay. It's something weird on Zoom. We've been doing technology in Zoom for whatever, COVID now. I still can't seem to get it right. So thank you for chiming in, and I'll stop asking now. So anyway, so then we look at the 10-year treasury. Well, why do we look at the 10-year treasury? So the reason that we look at the 10-year treasury is actually really simple. So most people, when they look at a mortgage and they look at a 30-year mortgage, okay, they actually only keep that mortgage for, on average, around 7 to 10 years. So we look at the 10-year treasury, money that the government lends for, or excuse me, borrows for up to 10 years. We use that as our benchmark, okay? Now, most people would say that borrow or lending money to the government is what we call risk-free. Is it risk-free? Well, it's been risk-free. It's been risk-free up to this point. Who knows what the future holds? But anyway, we consider it risk-free. So right now, the 10-year treasury is at about 4.5% as of today, 4.45, I think to be exact. And so that is what we call risk-free money. So if anybody's going to invest in anything that has any sort of risk, then we know 4.5 or 4.45 is basically the floor as it stands today. I think most people would agree that real estate has some level of risk, right? And so they want to add a premium to whatever the 10-year treasury is in order to buy those mortgages, okay? And so, just a kind of quick recap, walk into Wells Fargo, they give me a $500,000 mortgage. Wells Fargo, in essence, reaches into all of their deposits that the clients of Wells Fargo have made with their paycheck and everything else, and they lend $500,000 to me. Okay. They can only do that, obviously, so many times. They need to get replenished. Well, the way they get replenished is they take all of these mortgages that they've made, they bundle them up into what we call a mortgage-backed security. And you can see that third arrow there says MBS. That is for mortgage-backed security. And then they take all, they take 1,000 loans, 10,000 loans, and they sell them to third parties. We do that on what we call the secondary market. So what does that mean? Who buys those? Well, insurance companies buy them. Insurance companies are notorious for hoarding tons of cash because they need it for natural disasters. The only way they can pay for those natural disasters is to take all of that cash and reinvest it. Okay. Let me see here. Let me see if we've changed the slide. Somebody says we're only on the first slide. I love technology. Give me 1 second, folks. You know how I said this was 30 minutes? It might be a little bit longer. Let me reshare this. All right. Does everybody see a slide with an arrow? I'm in presentation mode, but does that slide change for somebody? Yes. There we go. Man, technology. Gotta love it. If you have an issue, just chime in again. I got my chat box open. This was the first slide, so you're okay anyway. And so, excuse me, let me get back to where we were at. So they put together these mortgages, they sell them. They sell them to insurance companies, okay? They sell them to pensions, education pensions, city pensions. They sell them to anybody, any third party that is sitting on a lot of cash that needs what we would consider a relatively stable rate of return. Insurance companies can't go out and put $100 billion in the stock market, way too risky. They lose that money and there is no money for natural disasters, okay? And so they look at risk-free or low-risk things. So they can go to the 10-year treasury and that's fine, right? But they also want to look at mortgages because mortgages offer a little bit higher. And so they'll go out, they'll buy $100 billion worth of mortgage-backed securities, and that replenishes the cash to Wells Fargo and whoever else you want to mention so they can go ahead and make new loans. So hopefully that, I know we had some interruptions with the slides and the volume, but hopefully that makes some sense. So When we look at interest rates for mortgages, they are long-term rates. So what the Fed is doing with their policy is adjusting those short-term rates, not long-term rates. And very few people truly understand that there is a difference. So if you're going to watch one metric, I wouldn't watch what the Fed does if we're talking about mortgage rates. I would watch that 10-year treasury. That 10-year treasury is going to be the floor. And if you look back in 2020, 2019, 2020, 2021, when we had really, really low rates, you can just go look at what that 10-year treasury was. And it was way, way low. And I have an image that I'll show you here shortly. Okay. And we'll compare it to interest rates. Mortgage-backed pricing by investors. So that's our third arrow on there. So what does that mean? Well, what ends up happening is if we know that the risk-free rate is, again, today 4.5%, 4.445, I believe, then I need to be, if I'm going to buy these mortgages, and these mortgages have more risk than the risk-free rate, I need to have a premium. Okay. I need to be paid more than the 4.45 because I'm taking on risk. And so usually mortgages end up being 150 to 200 basis points above the 10-year treasury. In essence, that just means 1.5 to 2%. So if today the 10-year treasury is at 4.5, I would expect interest rates to be probably right around 6.5%. And if you were to go get a mortgage quoted today, you'd probably land somewhere in there. Again, income, credit, all of these things make a difference. But you're going to be landed right around in there. So really what we want to do is we want to try to push that 10-year down. If that 10-year gets pushed down, the long-term rate gets pushed down, then interest rates will actually start to be alleviated, okay? And then the lenders set the mortgage rates based on what the secondary market is willing to pay. And so one of the things that is important to understand is it's not just, oh, well, the 10-year is at 4.5 today, so let me add 2 percentage points. It's also a forecast for what we think is going to happen in the future. If you made me a loan today at 6.5%, but you thought that next month the risk-free rate, which is currently at 4.5, was going to go up, you wouldn't want to add 2% to today because next month you've got this loan that I'm committed at 6.5%, but now the risk-free rate went up and you could have got more next month, right? And so one of the things the mortgage-backed securities are doing is not just looking at today's market, but looking forward and saying, okay, gosh, what is it going to be tomorrow? What is it going to be next month? What is it going to be next year? Because if we feel like that rate is actually going to go up, then we're going to pad the mortgage rates that we're giving out today to offset what we might be able to get tomorrow. And that's what you're seeing occurring. And that's why you're not seeing rates come down. They use the 10-year as the floor, and then they look forward. If they thought the 10-year was going to go down, then they would add their 2% and be happy as they could be right now. But the fact that rates aren't coming down, and as a matter of fact, they're over a little bit more than that 2%, that is you telling, or that is the mortgage background, the mortgage secondary market saying, we think that 10-year is going to go up. And in fact, what has the Fed been talking about lately? Rate hikes. They think because inflation, the rates may actually go up. And so that's why you're not seeing mortgage rates come down. So hopefully we could talk about this for hours. We don't have hours, and I want to get through the slides, but hopefully that makes some sort of sense. And the difference between the Fed making policy action on short-term rates and your car loan going up and your HELOC and your credit card, and then actually looking at mortgage rates and saying, gosh, when they did cuts, I didn't see mortgage rates come down, right? And that's because they're using two different metrics, and a lot of people don't understand that. I just changed the slide, so hopefully you saw a slide change on your end. If not, obviously just chime in. But this is a quick snapshot of the last 5 years. The upper left is the 10-year that I was just talking about, and the lower right is mortgage rates. And you can see a distinct correlation, right? Look how low the 10-year was back in 2021 to 2022, and look where the interest rates were. And as that 10-year has gone up and had a couple peaks, you can see the mortgage rates do the same thing, okay? But yet in that time frame, we have actually had the Fed cut rates several times.
but you don't really see that mirrored here. You see it more mirrored on the 10-year. And so, again, if you really want to get good at this stuff and you really want to try to figure out where mortgage rates are going, I wouldn't ignore what the Fed is doing. I would listen to what the Fed is saying, but I wouldn't necessarily pay attention to what they're doing. They are taking action on the short-term rates, but what they say is all about the future. As a matter of fact, yesterday was the first press conference for the new Fed chairman, Kevin Warsh, and he basically said, we're going to stop telling you what we think the future holds, which caused a whole lot of uncertainty and caused the market to get really, really scared yesterday because it's one thing when you get a forecast for the Fed in the future because you can say, okay, this is where some of the smartest people in the world think the market's going. Great, we can plan ahead. But now we're not going to get any indication on where the Fed thinks the actual future is going to be. That means that it's going to cause instability inside that 10-year, which is going to continue to cause instability inside the mortgage rates. And so, kind of a macroeconomic lesson there. I just wanted to make sure we understand. I'm happy to dive deeper sometime with us or do a whole nother kind of lunch and learn on just the bond market. But again, ignore the media. I shouldn't have to tell you that, right? From that standpoint, when they start talking about the Fed dropping rates and then they try to correlate it to mortgages, there is a downstream effect. If overnight money and short-term money becomes more affordable, look, without a doubt, long-term money will as well, but it's not for the same reasons and it's not in the same time frame. So anyway, just wanted to go over that because if you don't know where rates come from, talking about mortgages almost becomes a moot point. The other thing I'll mention for any brokers on here or potential buyers or sellers, understanding how this movement works can help you make decisions. So if I'm a buyer and I think I'm going to buy in 6 or 12 months, and I'm obviously concerned about the interest rates, I want to learn as much as I can about the 10-year bond. That's it. Learn as much as you can about the 10-year bond, and I promise you, you'll watch the interest rates correlate pretty darn closely. If I'm a seller and I'm like, gosh, should I sell now or should I sell a year from now? Well, ask yourself, is it going to be more expensive for my buyer right now or a year from now? Well, what's that determinant? Well, that determinant is going to be that 10-year bond, and because that's going to dictate what interest rates are. Same thing as a broker. When I give advice, I'll go in and one of the first things I'll sometimes lead with clients is a macroeconomic lesson. Hey, before we worry about price and what should we do to the house and all of that fun stuff, let's actually sit back and decide where the market's going and if we think this should be the best time or not. Obviously, there's no doubt about this, that there's a lot of craziness going on in the world, so things change really fast, and you can only make decisions with the information you have at hand. So, one other thing I want to mention, there's two other things I kind of want to mention. So one is on the right-hand side. We've already talked about the 10-year. I told you about the 1.5 to 2. It has 2.5% there. That 2.5% bump on top of the 10-year treasury, that is usually in a really volatile market. So if again the 10 years at 4.5 and just about everybody thinks that 10 years going up in the next 2 to 3 months, you may see 2.5% get added to that rate for a mortgage rate simply because they're trying to offset today where they think it's going in the future. But usually 150 to 200 basis points is kind of the main gap there. Fannie and Freddie. You don't need to dive deep into understanding Fannie and Freddie. I would guess that a good number of people on here have at least heard what Fannie and Freddie are. But in essence, what they do is they buy a lot of those mortgages I talked about from Wells Fargo and other companies, and then they package them together. So Wells Fargo isn't typically doing the packaging of those loans. They're selling them to Fannie and Freddie. Fannie and Freddie is packaging them. They'll take some from Wells Fargo, some from Bank of America, etc. And they'll put them all in one bundle, one mortgage-backed security, and then they will sell them on the market and they make a little spread. And that's how Fannie and Freddie operate. And so those three things we've kind of already talked about on the right hand side. Again, we just on the left hand side where I talk about, the markets are weighted in risk tolerance and future rate forecast, right? And so risk tolerance is basically, let's talk about the asset itself. Where do we think real estate is going to go, right? Do I think values are going to drop? Do I think unemployment's going to go up and we might have higher foreclosure rates? That's my risk tolerance. If I feel like, and let's say I'm on the secondary market and I run an insurance company or a hedge fund and I'm looking at mortgage-backed securities and I'm trying to tell them what interest rate I require to buy that fund of $100 billion or whatever, okay, I'm looking at where do I think real estate is going. If I think real estate values are going down or foreclosures are going up, I'm going to require a higher rate of return to get involved in that asset class. If I require a higher rate of return to get into that asset class, the consumer is going to pay a higher mortgage rate. That's it. So we look at risk tolerances and where the market's going, and then we look at future rate forecast. And that's what I was just explaining when we look forward and say, hey, if I think the 10-year is going to go up over the next few months, then gosh, I'm going to put a higher premium on today's rate. So when I get there in a few months, I have a market rate that I should have. The other thing that's really important to understand when you look at this is inflation. Okay. And so when you look at inflation, in essence, as inflation goes up, our dollar is worth less, right? Not worthless, just worth less. And so as things get more expensive, unless my income stays at the same pace, which typically it does not, okay, then overall the dollar I have in my pocket just buys less than it did a year ago or 2 years ago or whatever. Okay, that's inflation. Well, if inflation is going up, then I need to earn a higher interest rate on my investments to make the same amount of money, right? So if my dollar is worth less because of inflation, I need to earn more to almost break even. And so that requires that 10-year bond to stay higher artificially for longer until inflation comes down. Okay. And so that's why you have the long-term rates that are having a harder time coming down. They're more sensitive to things like inflation because if we think inflation is here for a while, then that long-term rate is not going to come down. And you can see it. Go look at a chart. The 10 year is not coming down and it's correlated to where our inflation is. So if you really want the 10-year to go down, you need a couple of things. One, you need inflation to cool down. If inflation cools down and my dollar is worth more inside of my investments, then I can go ahead and I can have a lower rate of return because again, the dollar is stronger. Okay. And so those are things that I really need to do. Now, another problem we have with this, hopefully this is a great macro lesson. I love economics, so we'll spend a little bit of time in here. But the other problem we have is, look, when a government sells a bond, okay, what they're doing is they're raising money, they're taking a loan from the people so they can pay the bills, right? That's all they're doing, okay? Well, what ends up happening that can be really tricky is as that interest rate that they have to offer to people stays high, whether it's because inflation or geopolitical issues or whatever it may be, the government is going to pay way more interest than they would need to if somebody would buy those same bonds at a lower interest rate. And so what ends up happening is a weird byproduct is because they're lending money to the people at a higher interest rate, the interest that the government has to pay, the interest amount is going up. That's our national debt. That's why you see our national debt going up so fast. It's because the interest rate that they have to lend at is going up. And so the interest is going up. Well, then you say, well, gosh, what would make that go down? Well, if we can get the 10-year to go down, then they pay less interest. It helps the national debt. But when people say, well, do we believe that the US government is always going to be able to pay back these bonds? People say, well, gosh, look at the national debt. How secure are they? And so it's a really, really tough spot to be in because you need people to buy the bonds so we can pay previous interest commitments and pay our bills. But the byproduct of that is our national debt's going up, which makes us feel less secure in the purchasing of the bonds to begin with. And the way you make people more excited about buying the bonds is to offset the risk. And the way you offset the risk is by raising the interest rates again. And so it's a really tough, vicious circle to get out of. But again, nowhere in there does it have anything to do with the Fed and the short-term rate. So with that, that is our macro lesson. I'm going to kind of dive into more kind of topic-based stuff right here. So let's talk real quickly about fixed or adjustable rates. I got kind of four quadrants on here, and I'm going to go over a couple things because this is something that's really interesting. As a broker, I get a lot of people that will ask me, well, should I do a fixed or should I do, an adjustable rate? A lot of brokers are going to tell you, hey, take the fixed rate. It's secure. It's easier. It's easier math to calculate. It's less risk. It's all of those things. And I would tell you that that is in fact true. And for the vast majority of people, hey, picking the fixed rate is probably a can't go wrong. But what ends up happening sometimes is there becomes a wider and wider gap between the fixed rate offering and the adjustable rate offering. And we could be looking at sometimes as almost a half a point or three-quarters of a point of an interest rate by doing an adjustable versus a fixed. Now you're not talking about a couple of pennies a month. You could be talking about real money here. And so we need to understand a couple of the differences. Well, I think most of us would feel comfortable understanding a fixed rate mortgage, right? It's locked for the full term of the loan. The interest rate is never going to change. It's usually 15 or 30 years. The vast majority of people do a 30-year mortgage. I have a note on here that the payment never changes. That's actually an incorrect statement. Your principal and interest payment never changes. But your taxes and insurance and HOA dues will inevitably change. And so your overall payment very well will change over the course of time and in an upward direction. It says it's best when the rates are low or the buyer plans to stay for 7 years. And I can explain that a little bit further later on. In the lower right corner, we talk about adjustable. So, some people will call it a teaser rate. But adjustable rate mortgages are labeled in a number/number. So you can see here I have commonly a 5/1 or a 7/1. What that is standing for, it is not telling you your interest rate at all. Okay, both of those numbers are time related. So the first number is the number of years that my teaser rate or my introductory rate is locked. Most of them are 5 or 7 years. There are some lower ones out there for sure, but most of them are going to be right around 5 years. So when you see a 5/1 adjustable rate mortgage, the first rate that you get is locked for 5 years. Then you have /1. The one means that every year after that first 5 years, the rate can change. Again, nowhere in there does it tell you what it could change by, what index it's changed on, none of those things, okay? And so it's just talking about time, okay? Excuse me. And I can tell you a little bit more about that. I have in the upper right, we talk about, hey, when it comes to fixed rates, you're paying for security, okay? And that sometimes financially is not always the smartest move. A lot of people say, well, I'm going to live in this house for a long time. And that's fine. It's not how long you're going to live in the house. It's how long you actually think you're going to have that mortgage. For instance, there's a saying in real estate. I hate it, but there is a saying in real estate, and it's called date the rate, marry the house. So basically means find the right house and then get whatever mortgage you can get today. And one day rates are going to drop. And when they drop, you just refinance it. You just dated the rate. I hate that for a bunch of different reasons. Mainly, you're making this strong assumption that rates will magically come down. The other thing that you're saying is that when rates do come down, that you and your partner, your spouse, or whoever is still both fully employed, making the same amount of money, so you can magically qualify still, okay? And that values haven't dropped, right? We might see interest rates that come back down to 5%, and they may be coming down because unemployment's really high and the market's terrible, or real estate values have dropped. And so all of a sudden rates are down at 5%, but you can't refinance. You don't have a job or the values have come down. So for any broker that's on this, and we have a lot of brokers on here, if you're on here and you're using that phrase, date the rate, marry the house, just do me a favor. And our clients are taking our word kind of sometimes as gospel. So just be very careful with that because you could be setting somebody up for a future failure, even though it may be done in an innocent way. Um, so that's something that you want to be careful about. But if I think I'm going to refinance in 3 or 4 years, well, why would I pay a premium for a fixed mortgage that I'm only going to have for 3 or 4 years? I'd be better off doing an adjustable rate mortgage. And as long as I refinance before that 5 or 7 or whatever that first term is, then I got the benefit of the lower rate for a few years and I can always refinance into a fixed rate. And so I'm not on here to give you financial advice and run the calculations and all of that, but I just want you to think about that. It's not how long you're going to hold the home, it's how long you think you're going to hold that loan. I've owned real estate for 20 plus years now. I can tell you, I've had a lot of houses that I've owned for a long, long, long time. I've had 3 different mortgages on them. I've refinanced 3 different times. Not a single time have I done a 30-year fixed. Again, not trying to give you financial advice. I don't want anybody to go out there and do adjustable rate mortgage. They get burned and they blame me. I just want you to think about this a little bit more critically. Okay. Now, in the lower left, I say that, hey, when it comes to adjustable rate mortgages, you need to understand the index and the margins. So, what the hell does that mean? Well, every single adjustable rate mortgage is going to show you what we call an index and a mortgage, or excuse me, an index and a margin. So the index is when we clear that first 5 years or 7 years or whatever it is, what index is the mortgage company going to look at to kind of set my new interest rate? They might be using, we used to use the LIBOR, but we don't anymore. They might be using prime rate. That's not typically what it is. That's more commercial based. They're probably using either the 5-year treasury, not the 10-year, the 5-year treasury, or they're using what we call SOFR, which is the secured overnight financing rate, which is very similar to the 5-year. So without getting into the minutiae of it, that's pretty much what it is. So that's the index, right? They might say, hey, look, at the end of your first 5 years, we're going to reference the 5-year treasury. That is our index. Well, if that's going to be my index, I better understand what the hell that index does or where that index came from or how it's created or how it's moved because there's a chance my mortgage in the future adjusts based on that index. And then the next thing is the margin. And the margin is basically how much over that index are they going to charge. So let's say I have a 5-1 adjustable rate mortgage and there is a 250 basis point margin on top of the 5-year treasury index. So what does that mean? That means in 5 years, my mortgage company is going to go to the 5-year treasury and the 5-year treasury is going to be 4%, for instance, right? All right, well, that's my index, 4% on that particular day for the 5-year treasury. My margin was 250 basis points, so I add 2.5%. And so my interest rate for that next year would be 6.5%, 4% plus 2.5. Then you fast forward 1 year, right? Because that /1 says every single year it gets reevaluated. I go back to that 5-year treasury index, and the next year it's at 4.25. Now I add 250 basis points for my margin, and I'm at 6.75. It can also go down, right? The third year, that may drop from 4.25 to 3.75, and I add my 2.5, and all of a sudden I'm at 6.25, right? And so every single year it can go up and down, okay? You typically are not taking an adjustable rate mortgage if you think you're going to go too far past that first change, that first 5 or 7, because the further you go into that, you do certainly accumulate more risk. Okay. All right. Um, Closing costs. This is another thing that I get all the time. Or a lot of people ask me, hey, look, should I pay my closing costs? Should I roll it in? There's a ton of lenders out there who say, we've all seen the no cost mortgage. That's the craziest thing I've ever heard. That's if you can't believe that. Are they working for free? Of course they're not working for free. What they're doing is they're going to increase your interest rate to offset all of those fees, or they're going to roll it into your mortgage, and all of a sudden you're going to have a higher mortgage payment that they're going to be earning interest on. So not only did you borrow your own closing costs because you increased your mortgage, but now you're paying them interest on top of that borrowed money. Okay. So, there's a couple different options. One is pay it out of pocket. How do I evaluate that? Well, it's all about where your money currently is. So if I have $8,000, let's say I have 10,000 just for ease. I have $10,000 in total closing costs. If I pay it out of pocket and it's currently sitting in my bank earning 4%, well, I'm losing $400 a year because I took the 10,000 out of my bank earning 4%, which is $400 a year, and now I'm not earning that money and I put it over here. Well, if my interest rate is 6.5%, well, I don't mind taking money out of a bank that is earning 4 if I'm saving at 6.5. It's a 2.5% smarter play, if that makes sense. Okay. Roll it into the loan. Rolling it into the loan, let's say I have a $400,000 mortgage. I got 10,000 in closing costs. Now I have a $410,000 mortgage. I'm obviously going to have a higher payment because I borrowed more and I'm going to be paying more interest. Now I fully understand sometimes financially you have to pick one of these less desirable methods. Like I totally understand that. Okay. Not everybody's sitting in a position where they can pick one, two, or three. Okay. And then obviously we have seller concessions where they're going to pay your closing costs. And we're seeing that more and more now just because it's becoming a little bit more of a buyer-friendly market. And really the way to look at that is, am I better off saving the cash or taking it off the price? Most sellers that I know, they're going to say, hey, I'm going to give you X amount of dollars. In this case, we'll say 10,000. I really don't care if you take it off the price or the closing costs. There are some minor differences between the two. If I'm worried about the house appraising, then I may rather take it off the price. That way it lowers the price of the house, a little bit easier for it to appraise. If I'm really pinching pennies and I say, hey, my broker's commission is based off the sales price, so I would rather lower the sales price because then the overall commission is lower. Most people don't think in that detailed, but those are differences that you could have happen. But then again, some buyers may say, look, the only way I can buy your house is if you do this seller concession. Then a lot of times they'll kind of roll the dice, right? And so a lot of people, buyers especially, they make this decision on the way that they feel. Okay. And I would encourage you to actually run the numbers, right? Look at the number of the $400,000 mortgage. Look at the number of a $410,000 mortgage. Look at where that $10,000 is and what is it earning. Again, I use the example of just sitting in your bank account. Like just know what it's costing you. I think that's really important. I have a quick example here. I won't dive too deep into it just for the courtesy of time, but you can see here, if we pay it out of pocket, then in this case, we had a $380,000 mortgage, 12,000 in closing costs. So if we paid it out of pocket, then our loan amount would remain 380. And our principal and interest at 7% would be 2528. Again, not taxes, insurance, just principal and interest. If we roll it into the loan, we go from 380 to 392. You can see the bump that we have there in the payment. It's about $80 a month. Over 30 years, though, that $12,000 will cost you somewhere in the range of almost $29,000. All that interest over 30 years does add up. Now, how many people actually hold the house and the mortgage for 30 years and never refinance or even hold the house? It's not that many. So you understanding how long you think you're going to hold that mortgage will help you make that decision. Again, this is not how long I'm holding the house. This is how long I'm holding the mortgage, okay? So you may not pay the full 29,000 in extra interest, but when you sell, you inevitably will have a higher loan amount simply because you paid or you had a higher mortgage to begin with, okay? So just kind of remember those things as you go through. One of the other things that I think is important, because I've been doing real estate for almost 25 years now, I get the benefit of working with the same clients over and over and over. And so there'll be many times that I will help a client buy a house, and then, for whatever reason, in 5, 7 years, they want to sell that house. And how conveniently they will forget that they did take that $12,000 in closing costs and rolled it into the mortgage, or they had the seller pay for their closing costs of $12,000. So it looks like they paid full price. And so they're not going to get as much back at closing, maybe when they sell the house, because they have a higher purchase price, because they didn't bring the price down because the seller paid their closing cost instead. So again, looking forward is going to be really, really important on all these different kind of factors here. ARM versus fixed, adjustable rate versus fixed. This is just the sample. So you can see here our top line is our fixed 30-year mortgage. I have it quoted at 6.25. That's not today. I'm just showing you an example. We're probably about a 0.5% difference there. So our principal and interest is going to be about $23.39, and our loan balance after 5 years will be about $354.50. If you look at the 5-year ARM, remember that interest rate is going to be lower. Okay, there's more risk, and so it's going to be lower. And so the payment is going to go down to $22.17, and my loan balance is going to be actually lower in 5 years. And it's like, well, why is that going to be lower? Well, it's going to be lower because less money is going to interest, so more money is going to principal. So the lower interest rate I have, I'm going to be chipping away at the principal faster. Okay. So, our difference there for a 0.5% in this loan example is about $122 a month, or about $2,200 after 5 years. Okay. And so we've already talked about, though, what happens at the end of that 5 year and how that may impact me. One of the things that I think is important to understand and talk about with our clients, or even if we're buyers or sellers, is to say, hey, look, okay, let's say I get to the end of that 5 years and for whatever reason, I can't refinance. Okay. All of a sudden, if that rate goes up, am I going to be negative? Well, not necessarily. Remember that for the first 5 years of that mortgage, because you had a lower interest rate, you were saving $122 a month or a couple $1,000s over that time period. And so even if the rate on the margin and the index goes up after that first 5 years, you kind of have to eat through all of that savings that you had through the first 5 years before you truly turn negative. A lot of people don't explain that well with an adjustable rate mortgage. I may have a year 6 where my adjustable rate mortgage payment goes up, and you're like, gosh, it went up over what my 30-year fixed payment would have been. Yes, that is true. But you have 5 years of savings by having the lower payment that you still need to work through before you truly become negative. So I think we sometimes do a poor job of explaining that if we're looking at it in its totality. Another real quick picture here is just kind of our principal and interest. Obviously, or I shouldn't say obviously, but I'll just make the kind of the fact, over time, when we have a payment that stays the same, our interest goes down and our principal goes up. I only show this slide, even though for some people it's like, yeah, that's common sense. I only show this slide because when we do a refinance, this chart kind of resets itself, right? So if I get an adjustable rate mortgage and I'm 5 years into it, at the end of the 5th year, I'm starting to chip a little bit more away at my principal, right? But if I refinance at year 5 and start the next clock over, probably a 30-year clock, all of a sudden this chart reverts back to year 1. And so sometimes it can be really hard if you're refinancing and doing these adjustable rate mortgages, or even if you're just refinancing in general, fixed to fixed. It can be hard to really, really chip away at the principal, because every time you restart or refinance, you're kind of going back to year 1 on this graph. And so I think it's kind of important to understand that. Just 2 more slides, and then I'll take some questions, and everybody can get on out of here. One thing I always like to talk about is, what do we do when we buy and sell at the same time? That, every market presents different issues when it comes to this. If you were a broker in 2020, 2021, 2022, kind of in that peak of COVID, it was so hard to manage a buy and sell at the same time, right? I could probably sell your house in 13 seconds, right, during that time frame. But then you may have to turn around and try to find another house that's got 50 buyers lined up front, out front, right? And each person's in a different situation. And so that was a really big challenge in and of itself. Now we're in a market where, it's taking longer to sell things. And there's still not a lot of inventory out there. And so somebody says, well, gosh, how do I manage that? How do I do the financing? And so I'll share with you just a few quick things to consider. I'm not going to go into all of these, but just in detail, just a few things to consider. So one is a home equity line of credit. So if you have equity in your house, which thankfully a lot of people do have equity in their house, you can go out on your current house that you want to sell and pull a home equity line of credit and take that money out of the credit line to use as a possible down payment on your future house. Now, a couple caveats to that. Obviously, there's an expense, right? It's usually not terrible, but there's an expense there. The other thing is, as soon as you open that credit line, it's going to count against what we call your debt to income ratio. It's going to count as a debt. Even if you haven't drawn on that money, it's going to count as a debt. So when you go to buy the new house and use that home equity line of credit as your down payment, understand that your income has to support that new loan that you've taken. And I've seen that mess people up before because they don't quite understand that. There are some lenders that will do what we call a bridge loan. And it's kind of exactly what it sounds like. We're building a bridge between property A and property B with a small loan that goes in between. And those can work out well. They're more expensive than the HELOCs. So the HELOCs are usually way more affordable. And if you have really strong income and your debt to income ratio can work, most people lean into the home equity line of credit. If your income isn't as strong and those ratios aren't as good as they could be, then sometimes a bridge loan works because the lenders are fully aware of what we're doing here, and they have liens to go ahead and protect themselves. There are some new equity-based programs that are coming out there. I've worked with a couple lenders that have qualified buyers using projected equity. And so we can then do something that's called a recast. And so what a recast is the lender approves you based on the equity you have in the house you need to sell. They approve you to buy the other house, your next house, before the first house is actually sold. So you're actually borrowing more than you maybe want because you don't have the equity out of that property because it hasn't sold yet. And then when that house actually does sell, you do what's called a recast. And all a recast is most lenders, if you're putting down at least 10,000 is usually the limit or the minimum. If you're putting down at least 10,000 in one payment, they will allow you to take that big amount of equity that you got from your house when you sold it, put it on your new mortgage, and where in a typical situation, that money just reduces the balance at the end, but doesn't change your actual payment. A recast allows you to lower your principal and adjust the payment downward. Okay. So if you don't know what a recast is, certainly research that for your clients if you're in that situation. And then the last thing I have on here is a contingent sale offer. In North Carolina, we don't have a contingent sale offer. As a broker, we are building contingencies through the use of our deposit structure, right? We're doing it through low due diligence or a structured earnest money deposit, those type of things. And so while we don't have any more of the traditional contingency as a lot of people think about them, there are ways that creative brokers can at least limit that risk for you. And so there's a couple options there to look at and work through. So couple key takeaways, and then I'll take any questions because I'm sure we're kind of pushing the time here. Match the loan to the plan. One of the things that I really don't like is when people are out there and they're spouting out financial or lending advice as if it's universal. As a broker, you need to understand your client's needs and where they're going and their comfort level with risk. You cannot bring your level of risk into the conversation. What you would do is almost irrelevant, right? You need to fully understand your client's level of risk, what their plan is, Hell, have they ever even refinanced before? Do they even know what it is? Sometimes we walk in with this base knowledge, making the assumption of, oh, I would just do A to B to C. How simple is that? And you've lost them, right? And yet you're giving them advice that is putting them in a risk position that they wouldn't normally want to be in. When it comes to closing costs, make sure you're having a conversation with your client. I know a lot of times we're looking for creative ways to make the deal work for the buyer and seller, but sometimes as a byproduct of that, we're giving poor financial advice, or I should say that we're giving financial advice without actually running the numbers. Don't just tell a client, oh, well, roll in the closing cost or ask a seller to pay for the closing cost without telling them what the alternative is. If Mr. or Mrs. Seller pays your closing costs, you are not going to get that money off the purchase price now. Are you okay with that? Do you understand what that means? Do you understand what that means for your loan value in a couple years, right? So understand that. Make sure you understand how rates work. Just watch the 10-year treasury. You don't have to be a genius in this. I by no means am a genius about this. I'm pretty well versed in it. But I can assure you that if there's one metric I watch, it's the 10-year treasury. I kind of joke that the stock market is basically, just day-to-day headlines, right? The stock market trades on day-to-day headlines. Wealth is built in the 10-year treasury. So, if you've ever, I don't know if any of my students are on here, but I harp on the 10-year because that's where real wealth is built. Because the 10-year is a really good indicator of what the future holds. I don't believe the stock market is a good indicator of what the future holds. I believe the stock market is a great indicator of whatever this morning's headline was, whatever lunchtime headline was, whatever 4 p.m. Headline was, and whatever BS comes out between 4 p.m. and breakfast tomorrow, the stock market will adjust on that. I'm not here for headline trading. I'm here for wealth generation for my clients. And so I need to know what's going to happen in the future. And that's what the 10-year is trying to tell us. So pay attention to that. And then move up buyers before you ever kind of really have a detailed conversation about their needs and wants. Help them understand the financing so they don't put themselves in a tough position. So with that, I know that was kind of the speedy version and I went on a little long. This is recorded, I hope, but gosh, after today's tech issues, who knows? And I will usually send this out. I'll put it on our YouTube channel and it lands in our newsletter. And when I do my next Lunch and Learn, the video link will be in there. So it will make its way to you for sure. And if anybody has any questions, I'm going to hang on for about 5 minutes. Please type it in the chat box. I'll read the question and I'll give you my best answer. And if you need to jet off now to go do some stuff, I totally understand, and I'll hang on for about 5. So feel free to put anything in there if you need anything.